Generally, what Bitcoin has done this year was very bullish. It recaptured all the broken MAs from last year.
Right.
And as long as it stays above them and on any back test, it holds them, that's structurally bullish, full stop. Okay.
This content is brought to you by Uphold, which is a great crypto platform that I've been using since 2018. Uphold has all the top cryptocurrencies, Bitcoin, and all the altcoins. In fact, they have 260 plus cryptocurrencies on their platform. You can also trade precious metals, stable coins, and 37 fiat currencies. In addition, they are available in over 150 countries. And this platform is fully reserved. They do audits, so you can trust that your funds are safe. No commingling, no lending out your funds. If you'd like to learn more about Uphold, please visit the link in the description. Welcome to the Thinking Crypto podcast, your home for cryptocurrency news and interviews. With me today is Sven Henrich, who's the founder and lead market strategist at NorthmanTrader. Sven, it's an honor to have you on.
Hi, Tony. Good to be with you. Thanks for having me.
Sven, I followed you for a long time, learned a lot from you. So I have a lot of questions as it relates to the markets. And look, the markets seem to be in some sort of conundrum right now. But before we get there, I want to get to know you a bit better. Where are you from and where'd you grow up?
Well, I've been kind of a world traveler for many years. Spent a lot of time in Germany, US, Poland, Ireland, you name it. But I've been home here in the UK for the last 10 years and actually enjoy this quite a bit.
And how did you become a trader?
Well, actually, in my case, it was, it's one of those life situations. In my case, I was originally in the corporate world, international corporate development, large companies doing acquisitions, so a lot of global travel. But then things kind of turned ugly in my life. My wife became very ill, my first wife, and unfortunately passed away. So then I was a single guy with two kids and, try to make other things happen. As obviously all happened during the global financial crisis. So just one thing after another. So I ended up looking at markets more intently. I've been always looking at it from an investor perspective, but then developed the flexibility to do it on my own. And as most people do, I made every single mistake in the book. It was quite an educational period. That's where I got involved in charting, technical analysis, and everything else. And as I dove into that, of course, became more tuned to how the real world works in finance, involving central banks and obviously everything else. And my background in the corporate world actually was really helpful in being analytical about the realities of the world. I mean, like I've been running across the globe. We've been looking at mergers, acquisitions. We know kind of how the world works, right? And it also helps with understanding companies and their balance sheets and everything else. So you just kind of started, learning from the ground up. And that kind of evolved into something else altogether, which I hadn't planned at the time. But I kept getting questions on Twitter many years ago. I said, well, if you want to, ask me this, that, the other, I'll put up a website and see maybe we can get it more formalized in a more quiet forum for discussion, meaning off of the main Twitter noise.
Sure.
And, it's kind of evolved from there. And over the last 10 years in particular, I would say, I've evolved quite a bit as well. This is a learning experience for everyone. And I think the last 10 years in particular have been just an amazing journey in markets. I've learned a lot along the way, and I think our clients recognize that as well, because we've been trying to navigate, especially the last few years, in probably a different way than we would have 10 years ago, right? And that served us well because the market landscape has changed so much. Of course, we all of us have gone through what would be arguably unprecedented times, and things have gotten ever more complex. And we see markets behaving in interesting ways. Let's put it this way. And what I like to do, we're focused on swing trading. We're not day traders, right? So we're trying to find areas where we're conviction to pursue the long side. We've in the past been also tried the short side on a conviction basis, but frankly, that's one of the lessons as well. Shorting is a lot harder than it is to buy. I mean, we see that right now. I mean, we just had this massive rally. We've shied away from shorting, thank God. We've been pushing the long side, talking about this at the end of October and into November. And now we see all volatility crushed again. Absolutely just nothing happening. I called it the pain trade that we saw from, for all the various reasons I outlined in November. That's happening now, and it's not letting anybody in. There's hardly any, you can't even call it pullbacks. I mean, we're just in chop range. So I call it the traditional frustration phase, right? Because the tapes keep squeezing higher and so forth. So you got to be very kind of tactical and strategic in terms of how to position long or how to manage long positions, scaling out at the same time, maybe try a hedge short here and there. So it's all part of a larger landscape that we all need to be very respectful of, because I said this on Twitter, I think about a month ago or something like that. It says, you can either argue with the market or you can choose to make money.
Yes.
And I've tried arguing with the money, and I've tried arguing with the market, but I prefer making money, right?
Right.
Just because we think something should happen doesn't necessarily mean it will. Certainly not immediately, because these markets also work in larger cycle structures, and this is where I think it's really important to also keep an eye on history and the big picture. So it's I try to mix it up with macro and technicals and history and everything else, and then we try to figure out always what is our best approach at any given time, and always be respectful of one mantra I've learned over the years, which is the extremes can become ever more extreme. That's to the upside as well as to the downside.
Yeah.
So that's kind of a summary on that one.
No, that's great perspective. And I had a question here. I was going to ask you, given that the markets change, the landscape change over time, and we have to adapt, what would, if you could tell your younger self as a trader, what advice would you give your younger self?
Well, the probably the most difficult yet most relevant skill set any trader can have is summarized in one word: patience. We're all trigger happy at some point, right? And the patience part is often challenged in these markets, but at the same time, when you do have a really interesting setup in terms of like a technical setup where you are convinced this could go, where the market could really pivot on that, there's also the other P, which is persistence. And I'll give you a real example just from October. I was of the view that we would have some sort of pullback in September, October. That's not magical. That's just pretty much standard expectation. I put out a video out, and I think the end of August, was called Mega Bull, where I had like this technical observation, not to get too granular about it, but there's a signal chart that got really oversold in August following the July peak, which was really unusual for August. And I always look back in history, and I saw just a few years where that happened, and it was kind of these presidential pre-election years, very odd. And basically what it said is, okay, we can retest the lows in September, October, or we can make even marginal new lows, and then that indicator would show a higher low, i.e. a positive divergence. It seems like a silly script, but that's exactly what happened. But so I knew we could have these new lows, and then of course the Israel war happened right out of the blue, which freaked things out, and all of a sudden things started dropping lower. So that's your kind of conviction moment. And I was at that point also challenged. I said, okay, is this going to hold? Is this going to break? And then I kept looking at also a very historical indicator. Just using this as an example where you get into conviction with yourself and the debate with yourself, because we had broken the weekly 50 MA, which was a key level of support. But then something really unique happened, and I had outlined this as this was the video right at the lower post. It's called Coil Spring, where I talked about a really unique confluence of the monthly 20 MA and the monthly 40 MA. They had touched each other a few times over the last 70 years or so, but never with price right at it. And the S&P was, during this correction, was dropping towards that price confluence of these two MAs. That had never happened before, and we were oversold. I mean, all these indicators were cooking to the downside, and lo and behold, we're approaching this level, and then magic. I mean, it's been nothing but up since then. So you will have moments where unexpected things happen, like the Israel Hamas situation, which clearly caused some consternation because there was concern this would broaden out into a regional war. And yes, there will be times when you get absolutely challenged, but you can either, I think the key question is to ask, is your setup invalid? Has it been invalidated? So if we drop down below the monthly 20 MA and monthly 40 MA, I would have said, yeah, if that drop is on a sustained basis. But it didn't happen. And guess what? Last year was exactly the same thing, except the key MA then was the 50 MA, the monthly 50 MA. And we dropped right to there. And that was the bottom in October of 2022. And then that's why I was suspicious last year, for example, with this whole bear market, because the thing that didn't make sense, and I think a lot of people were rightfully pointing out, that a bear market is not over until the VIX hits at least 45 or something like that. I mean, we saw that in 2011, 2012, I mean, 2015. You can go back. I mean, just basic corrections, you would have a VIX spike to that level. But that didn't happen last year. The VIX kept making lower highs, lower highs, lower highs from new low to new low in the S&P. And that was very, very suspicious. And ultimately, heeding that signal was very important, because every time the VIX hit that trend line, bang, we rallied. It makes little sense, and a lot of people say you can't chart the VIX and this, that, the other. I don't care. What I care about is what I see the market to show relevance of. If it's relevant to the market, it has to be relevant to me. So I better pay attention. This is why I say don't argue with the market. Look for what the market think is relevant, and then cue off of that. So that's how I'm trying to stay unbiased, because I've been guilty of this as well. And that is from a psychology perspective, going back against to thinking what the market should do, because we all have at some point level biases, right? We think, just look at headlines. Everybody's getting influenced by headlines. We saw that last year too, right? At the October lows, everybody was screaming S&P 3200, right?
Yeah.
People were screaming credit event in October of this year. Well, now 12, 13% higher a month later, everybody's screaming new all-time highs, and things just change, and it's easy to get influenced by that. But I think this is where we have technicals to keep us honest. Right. With ourselves, okay, and say, okay, well, now we want to be cautious, for example. Doesn't mean it can't go higher, but you want to follow a process. It does not give you the exact low, it doesn't give you the exact top, but it informs you of a shift in risk reward, okay? And that's where then patient comes in. Because risk reward tells you, for example, at a certain point, that now is not the time to start new longs. Rather, I wait for a pullback, but then the pullback may not come for a week, or 2 or 3 because the tape just keeps chopping around, and that's when people get trigger happy and they want to force a trade. And then what happens invariably when the trade doesn't work, they try again, and then they get frustrated, and that impacts psychology negatively as well. So that's why I keep going back to patience, because it's so crucial, I find.
Yeah, and it's so fascinating with human psychology, as you're saying. And is there a method to the madness with, if the herd is calling for lower lows, you do the opposite, and if the herd is calling for higher highs, you do the opposite? Is there some truth to that?
There is and there isn't, because when people are screaming higher or lower, or whatever the situation may be, it is obviously recency bias because of the way the tape has been working. So yes, you can make the case when the boat is getting too loaded one way in terms of sentiment, it can shift. But that can also take time, right? We saw that last year was a complex. I hate to call it a bear market because it was just so controlled and so clean, but we certainly saw obliteration on a number of asset classes. So I don't want to minimize it, but I refuse to call it a bear market at the end of the day because of a very simple indicator, and that's the yearly 5 exponential moving average. Never dropped below it, just tagged it, held, and bounced. And if you go back 7,500 years, that has happened many, many, many times, where you just have a correction, a negative year, a rare negative year, and then the 5 EMA just holds and goes. For a structural bear market, the way I would define it is you need to see actually price move below it and stay below it. You can have dips below it, and if you look back in time, and this was kind of an eye-opener for me as well, because I've been, probably somewhat rightfully been accused in the past of being a perma bear. It is my bears are idiots chart, because if you look at the history, to get 2 consecutive down years or 3 is shockingly rare since the Second World War. There were just really a couple of incidences what that happened in the 70s and in 2000. Everything else has been saved. It was just a 5 EMA attack on the yearly, and up we go. Guess what? COVID, biggest crash in our lifetime. It was saved by the end of the year. They closed it right back up. It was like, 6-week event, and boom, right? Yeah. And so you start looking at this stuff, and why people keep screaming bears? Corrections, perfectly legit. Calling corrections, no problem with that. But the history is the history, and at the end of the day, the global economy is growing through all that, all the troubles that come in between. Having said that, there's also very legitimate concerns on the macro side. I mean, I'm probably like everybody else. I'm just absolutely flabbergasted what's happening on the debt side, on the interest and the carry on that, and those are all concerns. Especially as we've gone through this massive rate hike cycle, and we can talk about that as well if you want. Just it seems kind of counterintuitive to say that we're getting through this aggressive rate hike cycle unscathed. But where's the recession? And I can point to, for example, I'm just sorry to go off topic a little bit, but I can point to the fact that the US is running the biggest non-recessionary deficit in history right now. With $2 trillion deficit, 7% debt issuance of GDP. That's the kind of stuff we only saw at the peak of the financial crisis. Obviously, COVID was bigger because that was a one-time event. But typically, this is the kind of deficit spending you see when you're in a recession. When they need to intervene, when the growth is not there. But there's all kinds of lurking kind of fiscal, I wouldn't say call it stimulus, but it's definitely a trigger that's out there that exacerbates growth.
So Sven, I was going to ask you on that note. One of my questions was going to be: are we in a light recession, and is it that the markets are reacting the way they are because they notice that the central banks are ready to hit that button to fix any problem that comes along and to mitigate any deep recession or 1929 stock collapse, right? When you look at the chart, it almost looks like it wants to do that, but it's being saved. Is that, the gist of what's happening here? Hi, everyone. Pardon the interruption. I'm Tony Edward, the founder and host of the Thinking Crypto podcast. I have a huge favor to ask you. If you haven't subscribed as yet on YouTube or the podcast platforms, hit that subscribe button, hit the thumbs up button, hit the notification bell on the YouTube platform, and on Spotify or Apple or wherever you get your podcasts, please leave a 5-star rating and review. It supports the podcast. It allows me to bring great quality content to you. Thank you for your support, and I'll let you get back to the content.
Well, to answer that question, let me dig a little bit into the past, okay? Because the traditional way of looking at this is, and you can look at past rate hike cycles. Ultimately, they pretty much all ended up in recession. Make it till you break it, right? The Fed raises rates until something breaks, and then they panic intervene. Why? Because something has broken and the economy is in a recession, and then they have to stimulate. And it's somewhere during the time frame of the rate cutting cycle, then when ultimately markets and the economy find a bottom, right? That's kind of traditionally it's been working. And my view, when they started all this, was also that ultimately they're going to end up breaking something. And I think a lot of people, myself included, I approached 23 to say, well, based on what I see, we should have some sort of big rally into the summer and fall. And then if there is a recession unfolding, then I can see new lows happening vis-a-vis October last year. But then, I also kept assessing what's actually happening as opposed to my, ill-informed opinion. And that's why you always got to be prepared to change your mind. Once I see two things happen. One is that deficit that I mentioned. The second is the banking crisis in March when they introduced the BTFP program to keep the banks afloat. And that's just been continued to be increased all year long. The other one is bank reserves, kind of one of those liquidity checks out there, which bottomed at the end of the year. They actually basically bottomed it in October of last year. That was, to me, that was the peak tightening cycle in effect of financial conditions, because that has never gone back down. We chopped around a bit this summer, but like in the last few weeks, it's just been increasing dramatically by several $100 billion. And if you look at that chart the last year and a half, it's just been directionally tied to the S&P at the hip. It's pretty fascinating to see that. If you ask me how tight this tightening cycle actually has been, if you look at Chicago Financial Conditions Index, it's never even got to restrictive, despite all these rate increases. So it's a bit counterintuitive. So if you want to frame this up to say, okay, well, maybe all these measures are a liquidity backstop that keeps things from falling apart. Specific examples, and also very relevant, I mentioned the VIX earlier with the lower highs. When things got shaky in the last year and a half, right at the moment when things looked to break down, things happened. October of 2022, the UK gilt was having a freak out. Bonds yields were screaming higher. The S&P was ready to drop to that below that monthly 50 MA. And right at that moment, Janet Yellen came out with that infamous headline. She's concerned about liquidity in the treasury market. And that was it. That was the top for yields in 2022. And yields dropped, and you had the strong correlation, because then the market was getting really freaked out about these higher yields. right? Makes sense. And so once yields reversed and the dollar reversed all at the same time, basically, then you had a major relief rally in equities.
Yeah.
And then it happened again in March of this year with this banking crisis, right? Because that was the key concern, that this could be a contagion. It could flip over to other banks. They're not prepared for these higher yields. So they intervened. And yes, Yellen came out and she was concerned about the banks. They introduced that program, and that was it again. And I noticed that the similar thing just happened now in October. And that is two things, actually. Every Fed speaker, as you probably have noticed, is been coming out all year long, higher for longer, higher for longer, higher for longer.
Yeah.
And then suddenly it was like October 3rd or 4th or whatever, Yellen comes out and said, higher for longer is not necessarily a given.
Yeah.
Interesting. Why would she say that? Why would she say that indeed? Now, yields kept rising in October, and part of that was driven, Yellen obviously had issues, right? They had the debt ceiling.
Yes.
And as a result, while this was dragging on, the TGA account that the US government uses to build cash for their regular financing operation had been completely drained. And they needed to refill that. And once the debt ceiling the can was kicked, so to speak, into the beginning of 2025, hey, no more debt limit for the next year and a half. Yeah, unlimited spending. They had to refill the TGA account, and they did so voraciously. And that created supply-demand imbalances in the bond market, and that contributed to yields rising even higher. And that started freaking markets out, again, obviously in September or in October. But guess what just happened? I mean, it's amazing. Again, as the market was just about to break critical support, the monthly 40 MA and the monthly 20 MA, they stopped filling the TGA account. All of a sudden, it moved lower. So for some reason, they paused. And guess what? Yields dropped. The same script from last October. And guess what? Big equity relief rally. Dollar dropped in conjunction with it. It's basically a complete replay from last year. I call them the two Death Stars, dollar and yields, because they just kept screaming. The chart was just not sustainable from my perspective. And yes, when you have a move like that, as it just did, this year, running over 5% there, you're risking that something does indeed break. So I hate to sound like, maybe I should put on a funny looking hat, be called a conspiracy theorist. I can't accuse anyone of anything. I just can observe, and I can observe that just at the time when the market hit a key critical pivot and look to break. And by the way, let's be clear. If the market does break in a major way, then you do have a recession. Absolutely. You do have a recession, because it just filters into everything. That just leads to confidence, retail, layoffs, sales, everything. And so there is this kind of imperative, I hate to say this, to save the market, because over the last few decades, markets, and that's been one of my general macro bearish contentions, is that the economy, the markets used to be about 60-70% of GDP, been flowing there for decades, right? 70s, 80s, and then something shifted in the 90s, right? When the big internet boom happened, and then markets became ever larger as part of the economy. In 2000, it got to 120% or so. Then we had the crash, drop back down to 70%. Then we had the housing bubble, got it back to about 110%. Then it dropped to 50% in the global financial crisis. And that marked the era of, I call it full-time intervention in one shape, form, or another. Because what we saw following 2009 was just one repeat intervention after another, QE2, QE3, you name it.
So is the markets now kind of calling the bluff of the Fed? They're like, we don't believe you. We see the M2 money supply. We see the liquidity flowing. We're going to call your bluff. And is that kind of happening now? Because they see the intervention coming in every time there's some issue.
While we're still in this official tightening cycle, I think there's two things going on. First, let me just finish off with this. So after COVID, because they had just printed a ridiculous amount of money, the market cap to GDP equation went to 200%. 200%. It just blowing out the tech bubble, everything else. It just was insane to see that. And guess what happened? I mean, we got the big correction in 2022, and we got back to basically the level of the peak of 2000. And now we've been moving up from there. What I'm saying is that the markets have become so large vis-a-vis the economy that they are an imperative. If you want to manage an economy with, a low unemployment mandate and a low inflation mandate, which can be counterintuitive at times, in the sense that you can't have both at the same time, as we just recently seen. You are risking a major blow up, especially in context of all this debt has been added over the last 30 years. I mean, it is a debt finance economy. It's a debt finance market. And it is something that if we were to have another global financial crisis, it's not recession time, it's depression time. So I do think there is a very active, conscious awareness of this. And that's why it's probably not coincidental that when things get push comes to shove, that we do see these magic concerned words and programs, kind of backstops being put into the system. And the market may have sniffed us out this year, I would say, at least in parts of the market. But there is this conflict now, because structurally I would argue that yes, we still have lag effects coming through the system. They usually take 12 to 18 months, and maybe this is taking longer this time because we still had all this post-COVID cash flush in the system that takes maybe longer to wring itself out. I mean, savings rate have been dropped, excess personal savings have been depleted now. People are going more into buy now, pay later. Now, there's a great idea in terms of financing their holiday spending. But we've seen this before as well. The economy tends to do well until the lag effects take hold. So I'm not blind to downside risk at all. It's just that I put an article called Market Runway at the beginning of October, where, when you see the end of a rate hike cycle, it could take months, it could take years before you actually see a crack in the system. And markets tend to rally hard when the Fed pauses, when they stop their rate hike cycle. It's not until the traditional event happens, which is something breaks, and then they're forced to cut. And then they're cutting in response to, for example, the labor market cracking higher, which hasn't happened yet in this cycle. May well happen next year, I don't know. But it may also not happen. And if it doesn't happen, like in 2006, when they paused their rate hike cycle, you still had new all-time highs into the fall of 2007. Good luck fading that. Yes. So, timing, you got to be open-minded about timing when and if something does happen.
That's great perspectives, because I didn't think about it from a yearly perspective. Usually I'm thinking months, quarters, and so forth. But to your point, it could take years before something cracks. That's really great. I never thought about that.
Well, I always keep looking for things, be it edges. And like in the last few weeks, obviously the market's been frankly boring when the VIX doesn't move. And I came across something really weird I'd never thought of before after all this time. And, we look all at seasonal charts as well, right? I mean, you have a presidential election year, you have a presidential pre-election year, you have got a midterm year. And frankly, this year was shockingly just for all the things that have happened, for all the things that are going on, keep it simple, stupid, KISS. You look at a basic S&P seasonality chart. It basically set a low in March, rally into the summer, some pullback in the fall, and then a rip higher into the end of the year. For all the noise, that's basically all it's done. But I came across a chart I've never seen before, which was a 10-year seasonality chart. I never thought about looking at it through this perspective, but it went from 1897 to 2020. And that one was really interesting. I actually just put out a video on this yesterday. I called it something, a freak of history or something like that. And basically what it says is that the beginning part of a decade tends to be really weak. And then it kind of bottoms around the second year, starts cranking up in the third, maybe goes higher in the fourth, and then really cranks high into the fifth, sixth, and seventh year. And then there's trouble in the seventh and eighth year. So I look back at the last 24 years. It's like, okay. Oh, yeah. And then in the ninth year, it goes higher, right? What was in the ninth year? 1999, big up year. What happened in 2001, 2001, 2002? Big trouble, right? Then we just ramped into 2007. And then we dropped hard in 2008. It's like, okay, that's kind of the same script that we've seen. We even saw this in the next decade because, when do we start having trouble in markets? Well, 2018, 2019 was a big up year. And then 2020, at the beginning of the decade, crash. And last year, the second year, very difficult. And here's the third year, magic, we go back up. So I actually looked at a 100-year chart of the Dow, and there were 12 prior events, and 10 of them were basically straight up in the fourth year. 2 of them had troubles at the beginning of the fourth year because they were already in a structural bear market at the time. But I found it fascinating. It's like, are we that predictable as humans? We just keep repeating the same cycle over and over and over again.
Right. So cyclical, yeah.
It is. It's incredible. And basically what that tells me at this juncture, with everything having been saved, that maybe we'll get a couple of sizable corrections in the 24. But what it says is there's going to be a screaming bull market into the middle of the decade. And so, yes, if the initial rate cuts next year are coming accompanied by some trouble, i.e. a mild recession or what have you, or something blowing up or something worse, then yes, it may be initially bad for markets and it may cause some more back and forth. But all of that history, all of it says it's going to end up being bought. And here's another consideration for everybody. Now that the Fed has raised rates to the levels it has, you not only have the potential vast stimulus that's out there from them cutting rates back down, possibly even QE starting again if they need to.
Sure.
But because of the unique flows of this cycle, having come out of 13, 14 years of zero rates, basically, with rates having gone this high, this has been a real godsend for a lot of people to actually be able to park money in money market funds, in treasuries, right? I mean, just money market funds are like, what, $5.9 trillion in cash sitting there. And guess where that goes when rates drop again? It goes back into equities. So all of a sudden you get this double whammy effect of sideline cash, rate cuts coming, maybe QE coming, and we're back to the same program. As much as I may hate it myself,
Right.
because we just keep doing the same thing over and over. And one of my points was, you look, U.S. payments government payments on debt, that's $1 trillion whale right now, just to pay the interest payments. And there's so much maturity coming into next year and 2025, not only in the government side, but also on the corporate side. You cannot mathematically maintain this higher for longer narrative with the math reality of all this debt maturity coming. That's why I never thought this higher for longer was even serious. It was just a jawboning tool.
Yeah.
Right. So they have no choice. They have no choice but to cut rates and to bring all this down.
So Sven, not to get too philosophical, but question on that. With all these things said, and a lot of it is narratives and optics, trying to scare the markets a bit. But like you said, they actually can't maintain that, because going back to your point, the markets are such a big part of the GDP, like you said, starting like in the 90s, that if they don't maintain this, we could see an economic collapse, and then it's the end of civilization almost, because layoffs and all these things, and it'll be so detrimental because the debt is so high that they have to keep kicking this can down the road. I don't know what the solution is, but what are your thoughts on that?
Yeah, I mean, the entire system is junked up in a major way. The drug addict has to keep injecting drugs. I hate it. I hate it because it's ultimately, from a big macro perspective, it's been dreadful. Why? Because what we have seen as a result of this is just incredible disparity in society. I mean, it's the old adage, the rich keep getting richer, but it's reaching really absurd levels. I mean, the top 0.1%, this is based on the Fed's own data, the top 0.1% own over $18 trillion in wealth. It is that concentrated. It's basically back to record highs. So whatever, Payne Powell promised, it didn't hit the top 0.1% at all. And newsflash, there's only 38,000 households in those top 0.1%. It's just a class on its own. And so you look at the size of the middle class since the 90s, it's been shrinking and shrinking and shrinking, and there's been some improvements since, obviously, with the COVID payments, the bottom 50%. And so there's some relative improvements, but in general, it's been not a system that has worked for the majority. And that always has me concerned about the larger health of society, because we see it globally, actually.
Right.
Maybe social media had a big influence over this, but what we're seeing is a fragmentation of the political landscape, not only in the US, but you see it everywhere else, basically. And there's a brewing layer of discontentment, right?
Yeah.
People are struggling, people are getting frustrated, they're getting left behind, they're dealing with all kinds of issues, and so then you end up falling prey to more political extremes, be it right, be it left, what have you. And then societies, when you have such a fragmentation where you can't agree on a common reality anymore, it's becoming very, very difficult to govern, in a democratic situation. That's how democracies die, right? We've seen this before.
Yes.
The 20s, 30s, right? I mean, that's where all the trouble began, right? I mean, it was Germany, for example, right? It was the huge inflation episode, depression, you name it, and that's how you all of a sudden see a breakdown of the order, if you will, and then things can get really, really ugly.
So it's
And that's to your earlier point. So no, they cannot afford to let that fall apart, because if that then happens, then God knows what's going to happen, right?
So Sven, so on that note, and I'm going to ask you a hard question. What do you think the solution is to this? Like, how do we get out of the system? Because, like, to your point, it's happening globally. You just look at Argentina and the hyperinflation they're facing, and obviously they got a new president. Is it Bitcoin? Is it the blockchain? And look, CBDCs are coming. There's going to be benefits, but there's also risk. Is it something like that where money, they can program it, eliminate it from certain parts of the economy, force people to use it in certain ways? Is that the way to get out of this debt-based fiat system?
I as you probably know, I've been bullish on Bitcoin. I wrote a piece right at the beginning of 2022. Bitcoin had dropped 50%. And I said, all right, because Michael Saylor and I had a few discussions, and we were addressing this larger issue, in terms of the macroeconomy, this fiat system. And to me, Bitcoin offered, and this is where I can kind of turn the corner on my initial skepticism, was, yes, it is something that could be independent of all this. It is a limited supply type of situation. It has all kinds of problems in terms of adoption, and not, governments not liking competition notwithstanding. So my view was, okay, I'm still going to start nibble at this, but fully expect more lows to come, especially during the rate hike cycle. So the view was just to keep adding during weakness. And we hit I think that was also last time I talked to Michael, was we were hitting 17,000 or something like this last summer. And we've recovered greatly from that. And of course, since then we've seen the government getting very heavy-handed, and in some cases absolutely rightfully so, because the space had attracted one scam operation after the next, SBF, now Binance, one by one they fall. But that's a good thing, because you want the space to get cleaned up, right? You want to have some predictability there, and you want to have some safety there. And I think that's what we're seeing now, seeing price benefiting from that, in the last few months, and more optimism maybe to come. But I don't see how any government would give up its own currency. I mean, Janet Yellen is not going to drop the dollar, be absolutely clear on that. So they will fight any of that with tooth and nail, and maybe introduce their own digital currencies to offer an alternative, so to speak. Now, I've been pondering about solutions for a long time myself, but the issue is, once you dig yourself into a hole, that the only way you're gonna get out of is through tremendous pain. I don't think there's any appetite to go through that pain. I mean, the reality is we have regular election cycles. Like take the US, the Democrats and the Republicans generally can't agree on where the sun shines, right? They always agree at the end of the day, despite all the scary headlines, at the end of the day, they always agree to kick the can.
Yeah, raise that ceiling.
We saw that again this year.
Yeah.
Right? And it doesn't, people say, well, this guy is going to be the next guy, he's going to be fiscally responsible. Who has been?
Yeah.
I mean, the last time there was actually a budget surplus of any relevance was during the Clinton era, right? Because we had this big economic growth. And then it's also kind of easy, right? Because you have a lot of structural growth, you get tax revenues in, and so forth. But since then, it's just been one horror show after the next. I mean, we're at 120% debt to GDP right now. There's some countries that have 200%. It's frightening, and it's not sustainable with higher for longer at all. And they all know that.
Right.
They all know that as well. So it's and you can hope maybe, and maybe that's the unexpected solution, which I can't claim that it is, but let's maybe hope for a moment that AI, for example, will offer the gateway to massive productivity increase in the next 5 to 10 years, because that's been actually one of the things that's been lacking. Let's face it, all of these economies, all of them are suffering from a big structural issue, and that is birth rates.
Yeah.
The boomer generation, that whole cycle benefited from massive population growth. That's basically stopped in its tracks, with the exception of a few countries like Nigeria, for example, and so forth. But all of the Western world, it's a basic disaster. Without population growth, you got to have massive productivity growth to keep the economies on a upside trajectory, because without that, you cannot maintain all this debt financing that we have. So we do need productivity growth, and hopefully maybe that's it. Although, show me too, because I see a lot of fancy stuff on AI. I haven't seen anything yet that I can practically use, but
Yeah, macro investor Raoul Pal and I spoke about this recently, and he calls it the exponential age, and you have all these technologies converging. Maybe it's the space exploration that we're trying to do, AI, crypto, blockchain. To your point, these things help spur productivity, and we can get these economies in a better place and moving again. Do you agree with that? It's a convergence of this new industrial revolution and all these great technologies.
Well, whenever you're on the impetus of a new shift in technology, it offers tremendous promise, right? I mean, it's the undiscovered country. Industrial revolution, that was a completely undiscovered country. You never had that before. Awesome. Right. And that sparked a lot of good things and a few bad things as well, right? We had that with the internet, obviously, right? And that was great first, and then it blew up. And then it's changed all our lives to this day. So we always hope that there's a new trigger for advancement, because that's ultimately what we need, because the world has challenges. Let's not kid ourselves. It's not only debt and everything else. You get unexpected things like COVID thrown in. That it certainly can throw a curveball in it, but yes, obviously I love technology. I love how I use it. It wouldn't want to do without, but I also see negative impacts on society, right? I mean, just, I hate to say it. I mean, I see it with the young folks, and I know every older generation is complaining about the young folks, but, to have them focused on something is tough sometimes, right? Because everybody is so distracted. I mean, I've been around long enough. I grew up with all this stuff. I know how to keep myself also offline.
Right.
It is so easy to get sucked into this, and can actually be the counter to productivity. It's productivity killer. I see some people tweeting 100, 150 times a day. So what are you doing?
Right.
Don't you have a life?
Right.
I mean, oh my God, I couldn't think of anything worse. And there were times I used to tweet a lot more than I do now, because I'm trying to be really conscious of this. But it's not just tweeting, it's browsing, it's looking at everything that's out there, this dopamine kind of outrage. Look at this, look at that. No, I don't want to. I don't care.
I'm experiencing that I have a 5-year-old. So yes, that's a challenge, like you said, the attention and focus. Even myself, being on YouTube and podcasting, I have to take a break, go outside, get fresh air, make sure I build that into my schedule or I'm going to go nuts.
Unwittingly, all of us are subject to a really unique experiment in human history.
Yeah.
Because this has never happened before, and the amount of time that people spend on screens, I mean, not only for work, even for me as a trader, right? I have to look at screens, right? But then, you got TV and you got your phone and you got your apps, and I mean, it's just bizarre. So what I kind of back of my mind worry about is, okay, I'm not a teenager now growing up in this environment, but how are their brains getting rewired by this experience, because they never had any other experience?
Yeah.
This is all they know,
Right.
right? And then, this is where you get into teenage depression and all those things that are very real, that are happening. Because if you spend the majority of your time exposed to what's going on a device, by definition, the minority of your time is spent actually understanding how the real world works. And let's face it, the screen world can be very deceptive about what reality is, right? And that's the danger. And that's why I like when I mentioned the political divide and different realities emerging, and people are in their echo chambers of self-validations of whatever narratives they want to believe, and misinformation. And by the way, AI, that's just the classic jump board to just unbelievable misinformation, right?
Yeah.
I mean, someone can take you and I, download this podcast, reprogram the whole thing with our voices saying completely different things.
Oh yeah, deep fakes.
That's real already.
Yeah.
Right. I mean, we see these little joke memes here with Powell Yellen coming up, right? And it's not their voices, but it is their voices. It's not what they said. But, you and I may take it as a joke. Someone else may take it as gospel, right?
Yeah.
That's the danger. And, that's undiscovered country, how we're going to noodle through that. I'm sure we'll see a lot of that during the 2024 election.
I know we're coming up on time, so I want to talk about Bitcoin. We got the ETF approvals around the corner to halvings next year. What's your short-term outlook, if you can give a price point or range, and then your long-term, maybe for the 2025 all-time high?
Well, I still have to look at Bitcoin being correlated to the overall market, especially with tech. I mean, we saw that again this year. There were big correlations last year as well. This rally now that we've seen from the October lows, it's been absolutely massive. By the way, Bitcoin was signaling that, because it started rising before the market did. It actually held up pretty well during the September-October correction. This rally now has hit a resistance point. I always look at technicals, and there's a bit of a trend line I'm seeing. Generally, what Bitcoin has done this year was very bullish. It recaptured all the broken MAs from last year.
Right.
And as long as it stays above them and on any back test, it holds them, that's structurally bullish, full stop. Okay. We've seen resistance hit here in the 38,000 area. Last year during this bear market, Bitcoin actually broke a larger uptrend. That was a big concern from a structural long-term perspective. That trend line is rising, and it's rising into the 43,000 area. So you could even have a move to there, especially like year end or what have you. But I would consider it technical resistance. I don't think anything is out of the woods quite yet. Having said all this, given what I outlined with the larger 10-year cycle and so forth, if we do have some more corrections in 2024, I think everything will lead up to new highs in markets. Well, I'm following a larger structural chart on the S&P, on the NASDAQ, on Apple, and you name it. On all these things are screaming new highs. There was that moment in October when it looked like it's going to fall apart, but it didn't. I
Right.
posted a chart again today, and that actually points towards 5,400 on the S&P. So yeah, if you get that ETF approval, you get some of the house cleaning that we talked about.
Right.
And by the way, also impressive to me anyway, was that doing all the bad news with SBF and Binance, Bitcoin didn't really care.
Hmm.
It held through. I mean, that's one of those tests you want, right?
Yes.
Because you didn't really see any broad-based selling on that. In fact, money flows are still positive. Having said that, with the market rally, this is just a tactical call here right now. This rally just now in November was so aggressive that we got from very oversold to at least short-term overbought. So I would not be surprised to see some backing and filling here in the early part of December. One final consideration: if we do have a big year-end rally, I should add one more point. Equal weight's been terrible in this market this year, right? And tech's been leading a lot of that. Ironically, this is exactly what we saw in 1999. Equal weight was negative all year in 99, while the NASDAQ just screamed higher, and that obviously all ended badly, right? Equal weight is a little bit better now, but it's improving, and it still gives a runway. But here's a consideration for everyone. Wherever we close this year, let's say it's, for argument's sake, it's positive, with more gains to come, there is probably a window in Q1 of some trouble in general. And that is because while we're following a similar script to last year with yields and dollar reversing, there's a different implication. Last year, markets were down most of the year. So what happened in mid-December into the year end, there was a lot of tax loss selling. People throwing out their losers. Well, guess what? This year, they're sitting on big winners.
Right.
So there's an incentive to try to avoid selling before end of year.
Yeah.
And then that may bring about Q1 or beginning of year selling. So wouldn't surprise me to see again some sort of corrective type of activity. Then for now, everything looks strong. I would expect a pullback based on these short-term readings, maybe even in Bitcoin. But as long as any of these MAs are again defended, then it looks pretty solidly bullish here for year end, unless we get another surprise, which of course you never can predict. But
Sure.
that's kind of where I'm at. So long term, going into this mid-decade cycle, I don't see why Bitcoin wouldn't make substantial new highs vis-a-vis the old highs.
You think it's going to look like the gold chart after the ETF approval for gold?
Hold on. Oh dear. Yeah, gold is one of those things for very patient people, because it hasn't really moved since 2014. It's just got back to the same levels. It looks to be breaking out now. There's a little inverse there. And keep in mind, actually, gold really benefited from the money printing.
Yeah.
Not initially. Gold really kicked into gear after September of 2009. When they had cut rates and QE was in process. That's when gold rallied. So there was still some lag effects, but generally I think gold's been very frustrating for a lot of people because it just doesn't move decisively in one direction or another very much. But for now, the chart looks positive on it as well.
Are you trading only Bitcoin, or are you trading like Ethereum or any altcoins?
Not trading Bitcoin, just holding patiently.
Okay.
We're trading indices, mainly the S&P and NASDAQ and small caps. We like to keep it simple and confined. It gives us flexibility to move in and out as we see risk and reward shifting. So it's a process. We try to stay very true to the process. Sometimes the process gets challenged. That's par and parcel in any trading environment. But overall, I'd say the process has been working really well for us. So we're pleased. no complaints over the last 2 years.
So I got a couple wrap-up questions here for you. First is rapid fire. Favorite food?
Oh God, the things I can't eat anymore. Pizza. No, I've put myself on a heavy regimen ever since last summer. Post COVID, I just added way too much, so I keep a intermittent fasting diet. So I'm staying low carbs, heavy protein, low calories.
I did the same thing after COVID, putting on weight as well. I did intermittent fasting. Yeah, shed some pounds. So yeah, I'm with you there. Favorite musician or band?
Bizarrely, I'm actually I got some Irish bands that no one's probably ever heard of, like Lunasa. They've been one of my favorites for many years, but I like some of the classic rocks as well. So
Nice.
I'm broad based. Let's put it that way.
And favorite movie?
And a movie that stuck with me for many years. It's an old classic. Most people probably never heard of it. It's called Once Upon a Time in the West. It's with Jason Robards, Henry Fonda, Charles Bronson. It was probably the coolest Western ever made. Sergio Leone was the director. Ennio Morricone, the music score. Absolutely classic. It's a long movie, but it was one of those movies that you don't see anymore, and that it took its time setting up the scenes. I'll give you an example. Right at the beginning, there's a train opening scene. There's three
The
scruffy
harmonica?
guys. Harmonica, yes. You know that movie.
Yeah, my dad watched. I used to watch it with my dad.
Yeah. So this is like an opening scene. It took like 20 minutes to set up. It's just three guys sitting at the train station waiting for what? No one knows, And then finally some guy shows up on the train and things happen. But just the facial expressions, the setting, it was the whole movie was like that in that sense. So it was a classic. I always like that one.
Yeah, it's so artistic, and it draws you in. It gets you to focus and think about the character and the expressions on their faces. They don't. There's not much commentary or interaction from a verbal standpoint, but the expressions are so
expression in the music, because what they did so well is they actually crafted a theme music for each person.
Yeah.
So their story was tied up to the music, and it just worked emotionally really well. So great flick.
For sure. Favorite book?
Favorite book? I've got many. There's one I'm reading right now, also off the off the beaten path, which probably no one reads. But as I'm living in England now, I started really digging into the history here in England, and there's so much history here. It's absolutely fascinating. And I'm reading the Anglo-Saxon Chronicles. I know it sounds probably boring to everyone, but it's fascinating, because King Alfred, he commissioned some monks back then, scribes, to write down the history of what happened through the centuries as it was evolving. And initially I approached the book saying, well, if you're in charge of your own writing, you tend to want to write yourself in the best possible light, right? That was my expectation going into it. But no, it was very chronological. And when the Anglo-Saxons got their butts kicked by the Vikings, they are saying it. So they didn't miss any words there. And these references in there are fascinating. You can actually go to various places where these things were highlighted, and they're still there with evidence of them. It's fascinating, kind of a side hobby of mine. Do little man trips on the side. Say, I'm going to check this place out. I'm going to check this place out.
That sounds very fascinating. Yeah, I mean, to have that perspective going back to those days. One of my favorite books is Meditations by Marcus Aurelius, and being able to understand. Yeah. And
you have voices from that time in their words telling you what they thought. I mean, there's I went to Pompeii this summer in Italy, and it's just fascinating place. I mean, blew my mind, right? I mean, this is one of the only places you can see in the world that is actually structurally preserved. Not the grand monuments that you see like in Rome or in Greece or in Athens, but how a regular town functioned, how it was structured, how it was organized, and all the buildings are still there. The art forms are still in there, right? Yeah. Plinus the Younger, right? He wrote about this because his uncle was there when it happened, and so you get a sense of how these people lived, and it's actually quite fascinating, right? Because Rome was such a powerful, advanced nation and culture, yet it all fell apart, right? And maybe there's some lessons there as well, right? It's always, I always like the history and digging, trying to get a perspective of it, because none of us can know, right? Because we weren't there.
Yeah, I'm the same way, looking to see what I can learn. And it's funny because we were talking a bit about it. Human psychology doesn't often change. We can't help ourselves. We still do many of the same things.
We're the same people.
Yeah.
We may have different customs and cultures and so forth, but base humanity is the same. It hasn't really changed. For better or for worse.
Yeah, absolutely. So when you're not trading, what are you doing for fun as a hobby?
Well, these days, as I said, I travel as much as I can, which is not always easy given work requirements. Trying to just work out, have a good time. One of my favorite things, wood chopping. I know, sounds banal, but we live in England, cold winters, and so spring, summer, I'm always busy sourcing wood and sawing it up and chopping it up. That's it. I'm an easy maintenance guy. In the olden days, I used to skydive and do crazy stuff like that.
Oh, sure.
Not anymore. Wife won't allow it.
Oh yeah, my wife doesn't want me to go skydiving, even though I have it on my bucket list. But one day I'll convince her.
It's awesome. I mean, it's the first time in your life you're not connected to anything. I mean, it's the perfect illusion of human flight.
Oh yeah.
Yeah, I used to file on this back in the day.
Oh wow! So you did multiple times?
Oh, about 1,100 times.
Wow!
Oh yeah, that was a good time.
Wow, Sven, absolute pleasure chatting with you. I always learn something new when I listen to you and follow your tweets and everything. So thank you so much for joining me.
I'm glad to be with you. Thanks for having me.